As the U.S. markets are currently closed for the weekend, Tesla Inc. closed the last trading session on Friday, October 10, 2025, at $413.49, down a sharp $22.05, representing a significant single-day drop of 5.06%. While many retail investors using platforms like Robinhood or SoFi Invest might see that drop and immediately think of a buying opportunity based on the long-term narrative, what they're likely missing is the subtle but seismic shift happening under the surface. The real story isn't just about a volatile stock having a bad day. It's about the market beginning to reprice Tesla not as an untouchable tech messiah, but as a high-growth, high-risk automotive manufacturer that is finally facing a legitimate two-front war. On one side, you have the established giants like Ford and Volkswagen retooling with surprising speed, and on the other, a tidal wave of highly competitive and innovative Chinese EV makers who are no longer just a domestic threat. The expectation has always been that Tesla's lead was insurmountable. The reality is that the moat is shrinking, and that 5% drop is a tremor signaling a potential reevaluation of the entire foundation upon which its trillion-dollar valuation was built. Let's first anchor ourselves in the consensus view, the story that has captivated both seasoned fund managers at Fidelity and individuals engaging in self-investing for the first time. The common belief is that Tesla stock is more akin to Apple stock or Nvidia stock than it is to General Motors. It's a technology ecosystem on wheels, powered by visionary leadership, industry-leading software, a proprietary charging network, and a fanatical brand loyalty that other companies can only dream of. The bull case rests on future catalysts, the mass market success of the Cybertruck, the eventual release of a lower-cost vehicle, the maturation of its energy storage business, and the holy grail, solving full self-driving, which would transform the business into a high-margin software licensing and transportation-as-a-service provider. This narrative is powerful, compelling, and has been incredibly profitable for early believers. It's the story that justifies holding the stock through gut-wrenching volatility and has made it a cornerstone of many modern portfolios, including those managed by robo-advisors like Schwab Intelligent Portfolios. However, the recent market action challenges us to look beyond that well-rehearsed script. That 5.06% decline wasn't an isolated incident happening in a vacuum. It was accompanied by heavy trading volume, suggesting institutional players were behind the move, not just skittish retail traders. When you see big blocks of shares moving on platforms like Interactive Brokers, it indicates a potential shift in conviction among the largest capital allocators. This selling pressure is a direct reaction to a confluence of factors. First, macroeconomic headwinds are becoming impossible to ignore. Persistently high interest rates directly impact the affordability of new vehicles. A $50,000 car loan is substantially more expensive today than it was 2 years ago, and that directly curtails consumer demand, even for a brand as strong as Tesla. The company has attempted to counter this with a series of aggressive price cuts across its model line. While this has helped prop up delivery numbers in the short term, it has come at a cost that is now showing up clearly in the financials: margin compression. Tesla's once industry-leading automotive gross margins have been steadily declining. The expectation was that production efficiencies would offset these cuts, but the reality is that maintaining volume in a tougher economic climate requires sacrificing profitability, moving it closer to the profile of a traditional automaker. This brings us to the competitive landscape, which has transformed from a barren field into a crowded battlefield. For years, Tesla's competition was largely mocked as inadequate or perpetually on the way. That is no longer the case. Ford's Mustang Mach-E and F-150 Lightning are not just competent, they are popular and are leveraging a century of manufacturing know-how and a vast dealer network that Tesla lacks. In Europe, Volkswagen Group is aggressively rolling out a suite of EVs across its brands, from Skoda to Audi and Porsche, directly competing with Tesla at every price point. Perhaps the most significant threat, however, is emerging from the East. Companies like BYD, NIO, and XPeng are not just building cheap copycats. They are innovating at a blistering pace, particularly in battery technology and in-car software. BYD has already surpassed Tesla in total vehicle sales when including hybrids and is rapidly expanding its global footprint. The market is waking up to the fact that the future of electric vehicles might not be a monopoly, but a fiercely competitive global market with multiple successful players. The question for investors using investing sites to do their due diligence is no longer if Tesla will have serious competition, but how much market share and margin it will have to cede in the coming years. So, what exactly does the company do? At its core, Tesla's business is split into two main segments. The automotive division, which accounts for the vast majority of its revenue, includes the design, development, manufacturing, and sale of electric vehicles, the Model S, Model 3, Model X, and Model Y, along with the newer Cybertruck and Semi. It also includes services and its supercharger network. The second segment is energy generation and storage, where Tesla produces solar panels and its Powerwall and Megapack battery storage products. This dual-pronged approach is central to its mission of accelerating the world's transition to sustainable energy. The business model is built on vertical integration. Unlike other automakers who rely on a web of suppliers, Tesla has sought to control the core components of its technology, from its battery cell development and manufacturing to its software and its direct-to-consumer sales model. This was a massive advantage when it was scaling up, allowing it to innovate quickly. However, this capital-intensive model also carries risks, as it requires immense ongoing investment to maintain and expand, especially when facing competitors who can leverage existing infrastructure. Many investors who have set up an individual brokerage account with firms offering fidelity brokerage services have been drawn to this story of a company building the future from the ground up. Looking ahead, we're at a critical inflection point. The future outlook for Tesla stock can be framed through the lens of several competing scenarios. The bull case scenario, the one that still fuels much of the optimism, is that the current challenges are temporary. In this view, Tesla will navigate the economic downturn, successfully ramp up its new products, and its technological lead, particularly in AI and software with FSD, will ultimately prove decisive. If FSD is solved and gets regulatory approval, it would create a new, recurring revenue stream with software-like margins that could dwarf its car sales, justifying a valuation that rivals the biggest tech companies on the planet. The expansion of the energy business, especially as grids worldwide modernize, could add another massive layer to its growth story. This is the future that many using Fidelity mutual funds or Fidelity ETFs focused on disruptive growth on. The bear case scenario, however, is becoming increasingly plausible. In this version of the future, the competition continues to close the gap, commoditizing the EV market faster than anticipated. Tesla's price cuts become permanent fixtures needed to defend market share, permanently resetting its margin profile lower. Full self-driving remains a promising but perpetually just around the corner technology, a brilliant research project that fails to become a commercially scalable product in the near future. Under this scenario, the company's growth slows, and the market is forced to value it more like a best-in-class auto manufacturer with a solid energy business rather than a world-changing tech platform. This would imply a significant contraction of its price-to-earnings multiple and a much lower stock price, a risk that any provider of investment help must now seriously consider. There's a middle ground, of course, where Tesla remains a leader in the EV space but shares the market with several other strong players, leading to more moderate, sustainable growth. The key variable in all of this remains execution and focus. The considerable distraction of Elon Musk's other ventures, particularly X, is a tangible risk factor that cannot be discounted, as it diverts the attention of its indispensable leader. Comment below what you believe will have a greater impact on Tesla's stock price over the next 2 years: the successful mass production and scaling of the Cybertruck, or the Federal Reserve's interest rate policy. This is a core question for anyone engaging in online investing. In conclusion, the story of Tesla is no longer a simple one of a lone disruptor against a field of dinosaurs. The 5% drop is a symptom of a much larger reevaluation taking place. The expectation was for a smooth, exponential ascent powered by untouchable technology. The reality is that Tesla stock now operates within a complex and harsh new environment. It faces stiff macroeconomic headwinds, relentless margin pressure, and a growing army of credible competitors. Its future success depends less on the grand vision and more on the gritty, day-to-day realities of manufacturing excellence, supply chain management, and fierce price competition. For investors using any platform, from the sophisticated